Hello and good morning, good evening, or good day whenever you watch this video. This is now a very small one, I hope, because this is only on how is credit given to customers treated, and this completes our series of special topics where we have to know a bit about. Okay. So credits to customers is our topic for today. And let's have a look what can happen. Our problem today is relatively easy. The idea is just what do we do if we get interest paid from customers? There are different ways how that can happen. First way is the customer just doesn't pay in time. Then under the law, we have a claim to default interest. We can charge him amounts for paying late. Called, I hope at least I'm right here, is default interest. Then it might be that the customer might have asked us in advance, I see that I will not be able to meet the deadline for payment. So he asks us for the permission to pay later. That might be called an interest charge for deferred payment. And the difference to the situation before is just that now we gave an agreement. So now it's a rather more or less voluntary renouncing on punctual payment in time, for which we get a payment, the interest. Further on, it might be that you set contract conditions, the payment conditions, in a way that you say, if you pay very quickly, you get a discount on the price, let's say 1% or 2%, if you pay within 5 days or 7 days. If you pay within only 30 days after you receive the invoice, then you have to pay the full price. That's a very, how could I call it, very effective way usually to give people an incentive to pay very quickly. Naturally, the difference between the reduced price and the full price is basically economically a kind of an interest payment for the permission to pay, let's say 20 days later. It might even be that you just set a very generous due date without openly disclosing that there is an interest element contained. For example, if I say I deliver a machine for 200,000 euro to you now, and I set you a due date for payment a whole year. So you only need to pay the price 1 year after you got the thing, or half a year. Then this is so unusual and generous that economically there is clearly an element of interest contained in that price, which you will have to pay in 1 year. And it also can be possible that you make a separate official consumer credit agreement with your consumer that you say, yeah, you want to buy some things in my shop or some services here, and we set up a credit contract. You don't have to pay immediately. We fix payments or terms for the payback, either in a full amount after a certain period of time or in regular installments plus interest in both cases. Then you would have a regular consumer credit agreement. All these things can have different treatments under value-added tax because there are different rules underlying or different situations. If somebody just doesn't pay in time and you claim default interest, then that default interest is claimed because the customer did, without any permission from our side, just not pay within the allowed period of time. This interest is then completely not taxable at all because first, we did not allow anything to the customer. that person just did not do what was agreed upon, and automatically then we get a claim, a damage claim, for compensation of our financial damages due to the delay. We did not permit the later payment, we did not tolerate it, and we did not actively do anything. So there is no reason why we could see this as a service. And if there is neither a delivery nor a service, then we can't claim VAT, because taxable is deliveries of a good or services. And this is here evidently not the case. However, now your subconscious will say, or even your conscious will say, but there was an underlying delivery of a good and a service, and so that has to do with that now, that we charge him interest for delayed payment. So one could debate if what we charge now is not a later change, increase of the original price of the original delivery or service, so that we could say ancillary element of the original transaction, this increase in the price still belongs to the original contract, but an ancillary element of a transaction is defined as something which is meant to make the performing or the fulfillment of the original contract or services or deliveries more easy, and is usually accompanying these things. Now, if somebody violates the contract terms, you can't reasonably understand or interpret that as making the fulfillment of the contract easier if you violate the contract. So default interest cannot be seen as an ancillary element of the original contract and is therefore separate from the original payment. You have to judge it separately, and then you see what I already pointed out. It cannot be meant as as any service payment, because there was no service from our side. So we get default interest for neither a delivery nor a service, so nothing taxable. This is one of the rare cases where an enterprise can get money without being taxable at all. So if we postpone the due date, then interest charged for a postponement of the due date of a contract requires that we made an agreement. So now we receive the money later, and we renounced on the right to receive the money on time. And for that permission, we charge an amount. So this is a service in return for a consideration. So it's definitively taxable, provided, so under the condition that the place of that service is according to the general rules in our country. So then it's taxable. If the place of service is somewhere else, then it would be taxable there under their law. You cannot see the postponement of a due date as part of the original contract anymore, because it can't be an ancillary element of a contract if later you must allow to violate that contract or modify it. You can't see granting the permission to breach the original conditions as something which makes the fulfillment of the contract usually easier. Usually it's expected that you stick to the conditions. If the interest is now taxable, then it will be tax-free in the next step, usually, with exception of the rare cases where the entrepreneur can opt for the liability of interest. That would both be found in paragraph 4, number 8, and paragraph 9, USDG. You remember that there were several occasions where a tax-exempt transaction can be voluntarily transformed into a taxable a transaction which is liable to tax. Okay, so when you grant your customer payment conditions where you say you can pay quickly, then you can discount 2% on the price, let's say within the first 7 days, like here on the slide, or you have the right to, or the duty, however you want to understand it, to pay without any deduction within the next 30 days after reception of the invoice. Then basically that means you have to pay 2% more approximately for the right to delay your payment 33 days in my concrete example, because 98% of the price you have to pay if you pay within 7 days, and you have to pay the full price, so 2% more within 30 days. That means 2% on the full price for 23 days. By the way, a relatively expensive form of a credit. However, the question is now, how can that price difference be treated under value-added tax? Economically, it's clearly an interest. However, you know that under value-added tax, the problem is if several things happen between the same contract parties, you have to decide if it's all one transaction with ancillary and main elements, or if it's separate transactions. And now the question or the problem is that when you set up a contract over concerning a service or a delivery, you always have to agree on some payment conditions. It's virtually not possible that a contract has not implicitly or explicitly payment conditions. And that means you can basically not distinguish on which date would somebody have had to pay without this agreement or not. So necessarily payment conditions constitute an ancillary element of a delivery or service contract, always. So that makes it clear that this is an ancillary element. And ancillary elements, whatever you pay for them, will usually vanish from consideration. Everything will be treated as paid for the main element or main elements of the transaction. So if you come to the conclusion that the payment conditions, however they are just an ancillary element of the delivery contract or service contract, which is underlying the whole agreement, then there is no interest from the perspective of value-added tax. There's only two alternative prices, and so it's all what you pay. It's all a part of the price for the underlying contract, the underlying delivery or service. There is no interest. So ancillary elements do not count. Everything you pay was paid for the machine, for the software program download, or whatever. So if you set the due date immediately without discount, great. If ancillary element, no interest at all. If you set the due date later and be a bit more generous, that's also possible. If you set different due dates with different prices, also possible. However, never any interest, because it's just an element of the purchase contract which is underlying. So bad luck. Nothing which could be treated as free of tax as interest. The only thing what you can do is separate clearly the purchase contract and the credit contract with the consumer. In many states there are explicit rules for credits granted to consumers for purchases. So you will probably have to point out that if you don't want to accuse yourself of illegal activities, that actually what you made with the consumer is an officially acknowledged, recognized consumer credit agreement or contract. So separate forms, probably separate transactions, consumer buys, and then you make an agreement, probably on a standardized form, that there is credit granted, there will be payback conditions. For example, the guy pays back in installments or in a full amount after time plus interest. The interest must be clearly stated and all that. I'm not an expert in these things. However, in that case, when it can be seen as a different contract from the underlying purchase contract, then what you do is clearly a service. You lend somebody money or renounce on a monetary claim for a certain period of time in return for interest. So a service is what you render then, and if the place of that service is in the inland, then it will be taxable. As you are an entrepreneur and a credit given to a consumer happens in connection to your enterprise, this is clearly within the scope of your entrepreneurial activities. It's also for consideration because you demand an interest for that credit. So definitively taxable if the place is here. However, if it's taxable, then the interest will be exempt from tax for number 8 USDG. You know, granting a credit is tax-free. Yeah. However, one might think about, could you opt voluntarily to a liable interest under paragraph 9? And the answer is, in most cases, that will not be possible. If it's really a consumer credit, you can't opt to voluntary tax liability because, remember, paragraph 9 says you can opt only for certain transactions, credits, but only if your customer is himself or herself or itself again an entrepreneur and acts as such. So for a consumer credit interest, option to tax liability will definitively never be possible. Yeah, that's the end of this video. And remember, as always, if you like the video, first give it a like. Second, recommend the channel to others whom you like. And if you didn't like the video, recommend our channel to people whom you don't like. Thank you very much for watching. Till next time, goodbye till then, and enjoy the day.